The labor market is clearly cooling, job openings are declining, hiring is slowing, and wage growth is easing. At the same time, home price forecasts are moving higher as buyer demand stabilizes alongside lower mortgage rates. With inventory still tight and household formation steady, home prices are expected to keep rising in most markets, even as the broader economy continues to cool. Good afternoon. We're continuing to see signs that the job market is cooling, and last week's data added to that story. We were supposed to get the closely watched jobs report on Friday, but it was delayed to a brief government shutdown that took place earlier in the week. The good news is that the government is now back open with funding in place for most agencies through September of 2026, which lowers the chances of ongoing disruptions. There's still a potential funding deadline coming up for the Department of Homeland Security, but it's not expected to create the same kind of uncertainty we've seen over the past several months. Let's dive into what took place last week. Here are your headlines. The private sector added just 22,000 jobs in January, according to ADP, less than half of the 48,000 expected. Hiring was flat at small businesses, while medium-sized firms drove gains by 41,000 jobs. Large employers, by contrast, cut 18,000 jobs. 4 of 10 sectors lost jobs, and 3 saw only modest gains. Education and health services led with a 74,000 job increase, while business and professional services shed 57,000 jobs. Wage growth continues to favor job switchers, with pay rising 6.4% year over year, compared with 4.5% for workers who stayed in their role. So what is the bigger picture? Private sector job growth remains weak. According to ADP, just 398,000 jobs were added in 2025, well below the 771,000 added in 2024. That works out to an average of roughly 33,000 jobs per month, highlighting a clear slowdown in hiring momentum. It's also worth noting that these 2025 numbers could be revised lower once updated government employment data is released later this year. If that happens, it would further confirm that the labor market is cooling, which is an environment that often helps relieve upward pressure on interest rates and supports housing activity. Now, the softness in ADP is not an outlier. Revelio Labs reported 13,300 job losses in January in their non-farm payroll release. Their results gained prominence during the last fall's government shutdown when official BLS data was delayed. Unemployment claims also point to cooling conditions. Initial jobless claims rose by 22,000 to 231,000, the highest level since early December, while continuing claims increased by 25,000 to 1.844 million. Continuing claims have remained elevated for an extended period, suggesting unemployed workers are taking longer to find new opportunities. Labor demand is weakening as well. Job openings fell to 6.54 million in December from 6.93 million in November and remain far below the 2022 peak of more than 12 million. Because some remote roles are posted across multiple states, the true number of available jobs may be even lower. Layoff and hiring announcements further underscored the slowdown. Challenger, Gray, and Christmas reported 435,000 job cut announcements in January, the highest January total since 2009 and triple the amount seen in December. At the same time, hiring announcements fell to just 5,306, the lowest January reading since Challenger began tracking hiring plans 17 years ago. Taken together, these reports paint a consistent picture of a labor market that is clearly cooling. While this isn't a signal of an economic crisis, it does suggest easing pressure on interest rates, an important backdrop for housing as we move further into the year and buyers gradually regain confidence. Now, in Cotally's latest Home Price Insights report shows home values dipped just 0.2% in December. Even with this modest monthly pullback, prices are still 0.9% higher than a year ago, reflecting only a slight slowdown from November's 1% annual gain. The bigger picture remains positive. Cotally now forecasts home values will rise 4.5% in the next 12 months, up from their prior 4.3% projection. This improved outlook likely reflects expectations for easing mortgage rates and continued pent-up buyer demand. Real estate also remains one of the most reliable vehicles for long-term wealth creation. For example, a $500,000 home appreciating at 4% annually would gain $20,000 in value over just 1 year. highlighting the meaningful return potential for homeownership. This week shapes up to be another important one for the markets, with the potential to influence the direction of interest rates. The 10-year Treasury opened the week around 4.20%, briefly climbing to 4.25 and then settled back down near 4.2, highlighting how sensitive rates remain to incoming data. Several key reports are on deck, starting with the January jobs report on Wednesday, followed by the Consumer Price Index, or CPI, on Friday. We'll also get December's retail sales on Tuesday, with January's existing home sales and the latest jobless claims both scheduled for Thursday. I'll be in touch with an update next week, but for now, have a great rest of your day.